Teaching kids about how to manage money can be a daunting task. Again, if you look at the statistics that are out there about how many adults are financially illiterate, it's not really good. So it becomes even harder to actually teach your kids to do that, and that's where we get to some of these generational problems. Now, it's really hard, again, for us Gen Xers to be able to teach the next generation about how to manage their money when we were mistaught for the most part about how to manage personal finance. So in this video, if you are a parent who has a younger kid who's either just starting out, or they're in grade school, or they were just born, or they're maybe about to go off to college, I am going to talk in this video about 5 things that I think you should probably do to help prepare your kids for the world that is coming and how to be financially literate, and so at least they have more choices available to them in the future. There's also being literate with the YouTube algorithm, and the best way that you can do that is by taking your finger and gently tapping that like button and letting other people know, because that's what YouTube does when you hit the like button, that there are videos like this out there for them. People like you who might be looking for the same information. I appreciate it ahead of time, and now let's talk about 5 things that you can do to help prepare your kids for the coming future financial world. Obviously, the first thing is learning about savings. And not just, if you notice, I didn't say just go get a savings account, because you have to learn about savings. Because my generation, which is Generation X, we were taught about savings, and you see savings commercials all the time, but we weren't really taught how to do it. Right now, these days, and we still have them, the banks have very low interest rates. So if you're saving your money in there at a 0.5% interest rate, you're gaining far less on that money than you would be by putting it in the stock market, usually, or by having it in bonds or a CD, or having it invested even in cryptocurrency to some extent. Your money's not gaining that much. You're not going to lose any of it, that's a guarantee, but you're also, again, not gaining much as far as interest. But there are other ways out there that you can save money and get higher interest. Now, the conventional way, one of the best banks is Ally Bank. They offer a pretty decent return on your investment as far as your interest rate is concerned. Other ways are to look at international markets to park your money over there. Yes, that thing that we've heard about all the rich people doing about parking their money overseas. There are online banks that have different kind of rules. Again, you should check with your tax accountant or whoever else might be in charge of your finances or involved with your finances before doing anything like this and seeking out, because there could be things that are legal and could be things that are not legal. But if you find one of the legal ones, it's a good way to save money. And as I mentioned before, CDs are another good way to save money. U.S. Treasury bonds, especially at this time in history with financial uncertainty, a possible recession coming, that means the bond market's going to be pretty hype. And those are some other alternatives as far as places that you can save money at. But another one you might want to think about is cryptocurrency. Not so much to buy Bitcoin or Ethereum or Dogecoin or anything like that, but the US stablecoin on a lot of these platforms is a 1-to-1 ratio to the US dollar. And if you transfer your money in there and use that as your savings account, this is, again, not financial advice, this is just what's possible out there. But you could put your money in there, and instead of getting 0.5% interest, most of these cryptocurrency places like BlockFi and Vault and et cetera, they offer a much higher interest rate on the stable coin. The one thing to be aware of is that most of the cryptocurrency exchanges are not FDIC insured, so your money is not as secure there as it would be in a traditional bank. But again, that's the kind of the trade-off of the risk reward. The second thing they should really know is how investing actually works. There's a lot of people who think that it is like playing the lottery or something, and you know, at times it can feel like that certainly that you're, you know, putting your money up and hoping for a return, and it's just like scratch-offs. But it's a little bit, it's far more complicated than that. Put it to you this way, if you explain investing to your children, don't use it's just like the lottery analogy. Probably a better way would be to say it's like planting a garden. You're planting seeds and hoping that these seeds will sprout up over the next year, 5 years, 10 years, 15 years, and there'll be fruit or herbs or whatever that from what you've planted here in this garden that will keep coming back and back and back and providing for you. But you should also warn them, much like a garden, you could have years where you have cicadas and it might ruin your garden. You could have a mole infestation. There could be years where certain bad things happen to your garden and you don't make as much. And there'll be other years where you have perfect weather for 6 months out of the year. You get the largest apples, and from your apple tree you get tremendous amount of herbs and rosemary and thyme from your, because everything is just sprouting and growing so well. And that is basically a better way of looking at the stock market than telling them it's like the lottery. Tell them it's more like a garden. The third thing is real estate, which I have found when I have talked to younger kids, even like little kids, and you just have the usual funny conversations with them about what they think things are, and even up into teenagers, one of the things that they seem to understand very easily is real estate, which is, it's interesting because real estate is rather complicated, but they get the basic concept of it, and it's probably good for you to reinforce that concept. The best way to do that is by using your own house and explain to them, hey, look, you live in this house, and we had to pay a certain amount of money to buy this house. But since we don't make that much money, we don't have that much money at one time, what we have is called a loan. And over the next 30 years, we can keep paying every single month until we actually have paid off the amount of money that was needed to buy the house, and then pay back the people we borrowed the money from for the service of them loaning us the money. Again, I'm not sure why most of the young kids I've talked to seem to get real estate more than they get any other financial thing, but it is something that your kids should understand. And again, if you live in a house or an apartment or wherever you live at, you can explain it to them by saying, hey, look, this is around us, this is how this works, and this is why we're able to stay here. A fourth thing is something that's probably controversial, which is cryptocurrency, because there's a lot of people out there who still think cryptocurrency is funny money, play money, internet money. But here's the kind of the thing that they got to understand is that future generations are way more adopting cryptocurrency as a legitimate investment than prior generations, and that's only going to increase in time. And you have to understand that anything that we have value on or we put value on is basically a consensus of us as people. There's nothing really that we should say, well, you can make things out of gold or you can make things out of silver and they're great conductors and all this other stuff, but the average person isn't using gold for that. The average person wants gold because it looks sparkly and it's said to be expensive, and we all agree it's expensive, so therefore it is expensive. Well, the same thing applies to cryptocurrency. If the majority of people who are invested and involved in this stuff in the free markets consider that Bitcoin and Ethereum and Dogecoin and Litecoin and all the other ones are worth a certain value, and they all agree to that, then it has that value because it's agreed upon by the culture that the particular thing, no matter whether or not it's a metal or it's a piece of property that's constructed in a certain way, or if it's a piece of art, or again, if it's a bunch of zeros and ones on a computer, people have given it value. And in the future, if your kids don't have cryptocurrency, that's probably one of the first things you might want to look at. And the fifth one is a rather hard one. It is valuing the future. And it's something that we as humans are almost unique as far as species on the planet, because we are actually able to conceptualize the future, which many species are not able to do. So we can see ahead of time and get a rough estimate based off of what we know from the past, and that we understand that time is this thing that moves. We're able to prepare for that a little bit better, and that is something that definitely needs to be taught to your kids. I know when I was younger, and a lot of my friends when we were younger, we kind of understood the concept of time, but we didn't really get what it actually meant, and we got that it didn't really mean anything. Everything was about now and in the moment, and there are a lot of people who continue to live that way throughout life, and they're the ones that tend to have some issues. Now, I'm not saying that you have to be all stringent and strict with them and say you've got to save exactly this amount of money every single day, every single year, blah, 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 and don't do this and don't do that. Definitely don't do that with your kids, because that just, we all know it makes them rebel, and they'll do the exact opposite of what you tell them to do. But that's the key to all of this stuff, is not to tell them what to do, is to explain to them what there is out there and what the likely consequences are of doing this versus doing that versus doing that. And if you can get them to understand the ability to project into the future and understand, well, if you save your money when you're younger, the rest of your life will be a lot easier, or you could do it a different way where you just live in the moment and you don't really prepare for the future and you don't save up, and then you enjoy yourself in your 20s to 25, but as soon as you get around 25 to 35, then things start moving a lot faster. And then you're playing catch up with the rest of your life to try to pay off for what you did in your 20s. Very good comparison. You could sacrifice a little bit younger in life and then have a very easy life on the way through, or you could YOLO and live it up in your early 20s to late 20s and then have to pay for that for the rest of your life. This is also done by understanding bills and what happens when you don't pay your bills on time, and how interest rates is part of what I'm talking about, how it accrues over time. And if you're borrowing money now and going to pay it off in the future, instead of getting the money first and then being able to not have to be paying for something you bought 5 years ago that you don't even use and might not even have anymore, but you're still paying it on your credit card. That kind of understanding and getting that across to the kids is probably really critical, because it's one of the things that my generation and the prior generation really had a hard time with, which is credit and understanding credit and interest and how that affects us in the future. And maybe the old paradigm of rushing out of your house when you're 18 and then spending every single penny you have just to be independent and live free might stifle you from living freer in the future for a longer period of time. But then again, you might die when you're 22, and then you would have just spent your young years that you could have been having fun, wasting it being too conservative. So it's a catch-22. But that's the 5 things that I would tell the next generation. And if I don't know how you are with your kids, if you have kids or you don't have kids, or even if you don't have kids, young people, there are things that we should pass on to them. And I wonder if we are doing that, especially in Gen X, if we're doing as much of that as we possibly should be doing to kind of prepare the next generation to go further than what we did and to learn from our past mistakes. But I want to know what you guys think about this. What are 5 things you would tell your kids if you had kids? If you don't have kids, what would you tell the next generation about getting themselves ready for a financial future that is uncertain and is definitely going to be a lot different in 30 years than it is today? Let your voice be heard in the comment box below. Until next time, I will see you guys here for more news, rumors, and commentary on wrestling with finance. Be safe.